This video is for educational purposes only and should not be considered financial advice. The magic of trading the Ichimoku with ICT concepts. In this video, we will be going over the amazing Ichimoku Indicator that can help you gain confidence in the direction of your ICT trades. The Ichimoku Indicator has a variety of uses in technical analysis. However, we will be focusing on its use as an overall guide for price direction with ICT concepts. If you want a full description of the Ichimoku and its many uses, you can watch this video here. We will also put a link down below. What we will be focusing on: the Ichimoku Kijun-Sen line and the cloud, in conjunction with ICT's market maker model and PD array. The Kijun-Sen line. The Kijun-Sen line serves as support for trends in price. When price is trending and reverts back to the Kijun-Sen line, it usually goes back in the direction of the trend. If we look on this uptrend, we see when price hits this white line, which is the Kijun-Sen line, it continues in the upwards direction. Every time it touches the Kijun-Sen line, it continues upward. The same goes for the downward trend. We see the Kijun-Sen line stays behind price, and every time it touches it, price moves to the downside. The cloud. The cloud serves as a type of support and resistance, where price usually begins to trend once it breaks out of the cloud. Large clouds denote a strong trend and can be used as a point to trade to or trade from. Here we have a downtrend that formed once price broke structure and then retraced back into the cloud. It was rejected from this large cloud, which denoted a strong trend, and that did occur. You can also use the cloud as a way of staying out of consolidation and only trade when price is trending. Here we see a trend that happened and a large cloud. Then the cloud got small and price consolidated. This gives you a clue to stay out of this type of market action because the cloud is still too small. Here's the strategy. We draw the PD array, or the premium discount array, right before the session you are looking to trade. Draw out the most recent swing highs and lows that took out liquidity or rebalanced price. Then we look at the market maker model. Find out what level price is currently at. Wait for a level 2 or level 3 to be created. The Kijun-Sen and cloud confirmation. When price retraces to the Kijun-Sen or the cloud from level 1, 2, or 3, make sure the following occurs. Price is above the Kijun-Sen for a buy and below it for a sell. Price has touched and moved beyond the cloud in your trade direction. There is an order block or fair value gap near the same level of the Kijun-Sen or the cloud. Price is below the 50% of the premium discount array if you are looking to buy, and above for a sell. Let's take a look at some examples. Here we have a long trend that happened during the pre-New York session. Then at 9:30, price continued the trend. We drew out previously, before the New York session, a PD array where we see 50% is equilibrium. Once price continued during the New York session, we drew out another PD array. Now we also counted the market maker model. If we look from here, we see that price broke this structure, creating level 1. Then this is another swing level, which created level 2. Then this also is another swing level, creating level 3. Price retraced back into level 2, then continued downwards for a level 1, level 2, and then once price broke here, which you can't really see, this is a level 3. It retraced back into level 2 and then went down for an ABCD pattern where we have 1 and 2. Now we see a swing level created here. Price breaks that, creating level 1. Then that is broken to create level 2, and then level 3, and then a retrace back into level 2. Then we have a level 1 created here, then a level 2, and a level 3. What we're waiting for is a reason to buy. Since we are below the Kijun-Sen line and below the cloud, it is not advantageous to take a trade for a buy. However, if we did, that would have worked out. Instead, you can be patient and wait for level 3 retracement to come back to the Kijun-Sen line or to the cloud. We see that does occur here. Price comes down into this fair value gap after crossing the Kijun-Sen line. Then it touches the cloud. And once price crosses back above the Kijun-Sen line, then we know that price is looking to go higher. Price retraces back into the cloud. Once it closes outside of the cloud and crosses the Kijun-Sen line, that is your cue to enter. Plus, we are below the 50% level of our updated PD array and the original PD array. An entry here gives us a nice trade, which is probably a 3 or 4 to 1. Let's take a look at another example. Here we drew out our PD array before our London session. Then when London occurred, we updated our PD array. You could have taken a trade at the beginning of the London session to the downside, but sometimes it's better just to wait and let price give you more information before you place your trade. And here we see price is rejected from the cloud. It comes down back below the 50% of equilibrium on our updated PD array. Then it comes down into this order block. And now all we need is for price to move above the Kijun-Sen line and the cloud. And hopefully that will occur below 50% of equilibrium of the PD array. We also take a look at the market maker model. If we follow down here, this gave us level 3. You can count it, but this is basically 1, 2, and then 3. Then price creates a level 1 with a break of structure. It comes back again to this order block. And then once it crosses the Kijun-Sen line, which it does here, and it closes outside of the cloud, that is a legitimate entry. If you want, you can wait to make sure that this fair value gap is respected as price closes outside of this fair value gap. And that is the more conservative entry. And you still get at least 2 to 1 and probably 4 to 1. We are also still below 50% of the original PD array. Here's another example. This was our example from before. Price turned over, went through the cloud to the downside. If we count the market maker model, we see level 1, level 2, then level 3. And price retraces back into level 2, which is also an order block. This is our pre-New York session. So once New York happens and we see all of this messy consolidated price action, we can see that price is looking to get up into this order block. We are also above 50% of this PD array. Once price taps into this order block, we are inside the cloud. It closes outside the cloud, but we have not closed below the Kijun-Sen line. Once that occurs, here, this is also a break of structure from this swing low. Price retraces back into the Kijun-Sen line, and that is an entry. Also, this entry occurs right at or slightly above 50% of the PD array. Price then moves to the downside, giving you at least a 2-to-1 and possibly 5-to-1. Just to note, this retracement creates an ABCD pattern, which is level 1 that is created here after it clears this swing high. Then level 2 is created here after it clears this swing high. And that gives you enough confidence when price closes outside and then below the Kijun-Sen line that this is a valid trade. Let's take a look at a few more examples. Here we have the London session. We drew out our PD array. We look at our market maker model. You can count these here. This is level 3. And this is your Judas swing occurring when it should, which is during the London session. It's just one row of candles creating a level 1. Price retraces, creates a break of structure, and another level 1. This is level 2, and then retraces back right into this order block created here. This could also be called a propulsion block. This could also be called a breaker that occurs right inside of the cloud. Now we notice price does not return all the way back to the Kijun-Sen line. That will happen. As long as you have one of the confluences, your trade is still valid. Once price closes outside of the cloud, that is a valid entry. You can place your stop loss below the cloud or below the Kijun-Sen line, and you get a 2-to-1 and possibly a 4-to-1. In our last example, we will look at trading news. We had a Friday 8:30 core price news announcement on April 26 that caused price to go all the way back into this cloud. We drew our PD array during the pre-New York session. Price wicked that cloud and closed right below the Kijun-Sen line. It went up just a little bit more and then closed below it right here. Now this is an aggressive entry, but you can gain confidence because it engulfed the body of this candle. This is also in line with selling at a premium since we are above the 50% of the PD array. Now the more conservative entry would be to wait for a break of structure, which happens here. This creates a level 1. Price retraces back into this order block right here, and also this wick to the consequent encroachment of this wick. Once that occurs and price closes beyond, then this is a valid entry as well. That's the more conservative entry. You still get a large move to the downside. To recap, using the Ichimoku indicator can help give you context and confidence in placing your ICT trades. Once you know that you are on the right side of the trend, using ICT entries are easier to wait for and easier to see than on a naked chart. Also, shout out to Joel Harrison for inspiring this video. You can check his channel out here. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have any other video suggestions. Thank you for watching.